Hey, Daniil here. So obviously, this is a super huge, important topic. Money and funding is probably the biggest obstacle to anyone getting into real estate development or growing their development pipeline. There are other obstacles. Knowledge is closely guarded. That's one of the things we aim to tackle in our YouTube channel and in our content. We teach things that are normally not taught, but money is a big one. So in this video, I'm going to hopefully lay out some things that are going to help you. So let's get this out of the way. Development requires capital, period. It's a capital allocation business where you invest capital intelligently and it grows, earning you ongoing cash flow, tax benefits, and building wealth through amortization and appreciation. So where does one get this capital, and what kind of capital should one seek out? Those are great philosophical questions. One of the biggest advantages of real estate over many other investment methods is leverage. You can have a great idea for a building you want to build, find a private individual to put up some cash, and get the bank to fund the rest of the capital stack. Or you can take some cash of your own, use the bank's money to leverage that cash into a much greater amount, and own the building yourself without any equity partners. But you must understand how the pieces of the capital stack fit together. And I'm going to cover the concept of capital stack in a moment and which pieces come from where. So before we go any further, really quick, my name is Daniil. I build real estate. I build software for real estate investors. I started with zero, 17 years ago. I'm a first generation immigrant. We came here from Russia with my family back in 92. And I got into this business with zero money. I had a corporate job on Wall Street. I got laid off. I had nothing. I had no savings. So I think what we do, it's really possible for anyone to do with some knowledge and some grit and some hard work and perseverance. All right. So far, I've developed over 100 million in real estate. And I say almost with no outside investors because I think it's important. Anybody can go out and raise gazillions of dollars from other people and own tiny pieces of the deal. But I'll talk later in this video about my preference for how to approach this business. And I've typically been investing without raising capital with some partnerships and some strategic partnerships, but overall it's been my own projects. So, and we'll talk more about that in a second. I think it's going to be really insightful. Now, what you won't find on our YouTube channel, and I'm sad to say, are any videos of Lambos or me bragging about how much money I made. You know, I just told you how much real estate I developed because I think credibility is important, right? I didn't get into this business overnight. I didn't get into this business yesterday. But you're not going to find me on this channel bragging about how much money I made in real estate overnight or any motivational fluff. What you will find is real info that I wish someone taught me 15 years ago when I was starting out. Real info you can put to work tomorrow to be smarter, sound smarter, and do smarter deals. So make sure you watch this whole video. I'm going to go over the concept of capital stack. I'm going to show you where to get the debt. I'm going to show you where to get the equity. I'm going to give you my thoughts on whether you should raise equity or earn equity or both. And it's an important conversation. And I'm going to show you a money management principle that has been really transformational for my own wealth building and I think can help you as well. So who is this video for? Small to medium scale developers or those of you looking to transition into development. If you want to build spec home projects, if you want to build to rent, ground up multifamily, anything from duplexes to 20, 30 unit projects. And I say 20 to 30, maybe to 40 unit projects because any conversation around earning equity really become irrelevant once you move past 50 units because the equity requirements get so big. And at that point, you really have to raise equity. So let's talk about capital stack. In financing, there's a term called capital stack, and it refers to sources of capital to complete a deal. There's going to be a set cost for each project, and that money must come from somewhere. It typically only comes from two sources, equity and debt. The majority of any project will be financed with debt. That is the cheapest source of capital in any capital stack, and it doesn't take ownership on your deal. So in any deal you're structuring, you want as much debt as possible and as little equity as possible, as a general rule of thumb. Now, there are going to be deeper conversations that need to be had about leverage, and there's definitely such a thing as over-leveraging yourself, which I obviously don't recommend. But in general, debt will be cheaper than equity, so you want more debt and less equity. That being said, there is basically no such thing as true 100% funding for ground-up development projects, where you get 100% for land and construction costs. It just doesn't exist, except for one scenario, which I'll show you on the next slide. You're always going to need to inject some equity into the deal, whether it's yours or someone else's. In certain deals, it can be very little. In others, it will be more. Compared to traditional investing, where you've got to put 20, 25, 30% down when funding a deal, development can offer much better leverage, especially if you can source land below market value and take advantage of a concept called imputed equity. So, scenario one is if you're buying, let's say, an existing apartment building, you're going to have to go and put down 20, 25, sometimes 30% cold hard cash down on the deal. If you're doing development, you may be able to get away with an equity piece that's 10 to 15% of your total cost, especially if you can source land cheaply. The concept of imputed land equity is really important. It's basically non-cash equity credit given to a developer by lending institutions for land. So for example, let's say you buy a piece of land for $100,000. Its market value is $200,000. You now have $100,000 in cash equity and $100,000 in imputed equity. So the total equity you bring to the deal when you go and seek construction funding from a lender is $200,000. So it makes your effective leverage higher because you only have $100K into the deal, but your effective equity is $200,000. But you'll still need some equity to purchase the land, even if the bank will fund 100% of your construction costs. In certain scenarios, you'll be able to refinance the project quickly and pull that equity out. In others, you'll need to tie up that equity for longer. And I have a separate, longer video, actually I've got a bunch of them on their YouTube channel, teaching you exactly how to figure out your equity and debt requirements in any deal. I highly recommend you watch this video, and I'll link to it below. You learn how to determine exactly what amount of debt any deal can support, and that maximum amount will determine how much equity you need to fill the gap. For now, I just want to set the foundation. So the one exception where you may be able to truly fund 100% of land acquisition and construction costs is if you use a gap funder or a mezzanine debt provider instead of equity. There are professional hard money lenders out there that specialize in gap funding. And you can also potentially find a private lender willing to do it if they're willing to be in second position. But to my knowledge, this doesn't exist for larger deals. If you're building any kind of multifamily, for example, and what you will find most likely is that when it comes time to refinance into permanent debt, you're going to need to pay down the loan with cash, as it's just going to be too much debt for a permanent lender to give you. So this will work better for sale projects and then smaller deals. And again, the most likely scenario in new construction when you're building to rent is in a couple of years, you can refinance a big chunk of your cash into the deal out. Give it a little time for rents to grow, for your debt to be amortized, and you can refinance and pull either all or a big chunk of your cash out of that deal. And that's how you get into 100% leverage eventually. I hope that makes sense. So let's keep going. The ratio of debt to equity that you can secure in any deal is going to vary with the interest rate environment. In the low rate environment, your deal can support more debt because your payment on an equivalent loan amount is lower, and so you need less equity. As rates rise, your leverage on a typical deal will go down. This is also why as rates go up, you see a lot more creative deal structures out there with mezzanine debt, preferred equity, second liens, etc., etc. So as you launch or grow your development business, you need to think of these two components separately and constantly. Any successful development business has these two things: strong, healthy sources of equity and strong, healthy relationships with debt providers. So let's talk about debt first and where to get debt. We use, for most of our projects, local community banks. There's multiple reasons why I highly prefer dealing with local community banks for our development projects. First of all, these are local lending institutions that are mandated to lend in your town, city, or region. They have to deploy their capital in your area, and so they want to fund your projects. Oftentimes, these are very small to medium-sized lending institutions where you get to know your bankers in person. You build relationships with those bankers. You get to know them. You build trust. You build credibility with people on the ground that will fund your deals. And oftentimes, up to a certain loan size limit, these bankers that you get to know may have sole discretion over approving your loan. After it gets to a certain size, it usually goes to a credit committee. But smaller projects, it's not unusual for that banker to solely be able to make decisions on your loan and be able to approve them. The local community banks that we deal with typically will allow us to lock in our construction financing and permanent financing all in one loan. I highly prefer these deal structures because when I close on my construction loan, I have my permanent financing post-construction already locked in. It usually has a balloon on the permanent rate after 3, 4, 5, 7 years, but still it gives me a level of certainty. I know that after my construction period ends, I have permanent financing that's ready to go. I know the rate. The loan automatically rolls over. I don't have to seek a refi. This is very important. And these are portfolio lenders. They set their own terms. There's no going to loans to lenders here where they have to fit your loan into some sort of guideline box because they have to sell that loan to Fannie or Freddie. These are portfolio loans. The bank gets to set their own terms without having to have your loan conform to something because they have to sell it to Wall Street. This is really important. And typically, the best rates we're seeing are from these local community banks, by far. And this is important. Every bank I deal with allows for what's called imputed land equity. They don't care how much I paid for the land. What they care about is the market value of the land that I bring to the table. So if I'm really good at sourcing land cheap, I can create a ton of leverage for myself because I can find a piece of land for $50,000, but bring it to the bank at 100 or 125 as equity, and then build a duplex or build a quad and get the bank to fund big chunk or all of my construction costs because I'm bringing $125,000 of equity to the table. This is really, really important. So we use local banks to fund everything from spec homes to duplexes, all the way to large multifamily and mixed-use projects. Once you have a few great relationships with local or regional banks, doing more and more deals smoothly becomes easy. And here's a couple of resources, and I'll post these links at the bottom. But here are a couple of resources you can use to find local community banks near you. So what other options are there out there other than community banks? Well, you've got non-bank lenders. These are, think of these as like national hard money lenders. Oftentimes they call themselves private money lenders, but they're really hard money lenders. But some of these have really good programs. Just a few of them: Kiavi, Lending One, Dominion Financial. So if you go to Kiavi, you can see that they fund new construction. They list their terms, so you can see their rates, loans, The rates are high. 9.45% is quite a bit higher than what we're seeing from local community banks right now. As of recording right now, and this is me, I can borrow in the high sixes for construction and perm. So when you go to non-bank lenders, they typically will allow for pretty good leverage. You can see here up to 85% of total costs between land and construction. This is pretty good as long as you're under 70% of after repair value. And that's not bad, but the rates are higher, and typically they will not allow for auto rollover to perm. The underwriting oftentimes is easier than local banks. Some of these don't look at your W-2, don't look at your income. But the one thing that is hugely important to me is being able to roll over my construction loan automatically to permanent financing for any rental project they build. And to my knowledge, none of these non-bank lenders allow for that option. Rates are higher, as I mentioned. So what other options do you have? You can go to private money. You can get a private money lender to fund your construction. But this only really works in small projects where a single private money lender can fund the entire deal. But if you can find that, then use them to purchase land and fund construction, and then refinance it to permanent financing with a local bank if you can, pay that private money lender off, and then do another deal. And then you've got, for larger deals, insurance companies and other larger financial institutions that will fund land acquisition and construction. But if you're dealing with small to medium-sized projects, insurance companies typically won't look at those projects. Family offices, hedge funds, they're not going to look at deals sub, I would say, $10 million. What other options do you have for debt for build-to-rent construction financing? HUD has a very interesting loan program for larger projects. On their website, they'll say it's $4 million and up, but really they typically like to look at $10 million and up deals. It takes 18 to 24 months to close a loan with HUD. So it's a very long underwriting process. But one of the interesting options that they allow is rolling over your construction loan to a 40-year amortizing loan. That's incredible, right? It bumps up your cash flow. It allows you for more leverage because to hit the debt coverage floor, you can now borrow more money because your payment is less. And they offer non-recourse and assumable debt, which again is really, really huge, but you need to have larger projects. You need to have ability to be patient and wait 18 to 24 months to close this construction loan. But if you want high leverage, if you've got a big project and you want high leverage, you want non-recourse financing, right? Non-recourse means that you're personally not on the hook for the loan. Only the deal is. Then HUD may be an interesting option for you. So here's a tip if you're just getting started. Find a local commercial mortgage broker. I work with some local brokers still even now. Even though I have good local bank relationships, I still from time to time will work with a local commercial mortgage broker because their job is to have lots of relationships. Their job is to know every local community bank. Their job is to know every regional bank. Their job is to know these larger financial institutions. Their job is to know about all of these different loan programs, including HUD. And so even if you already have great pre-existing relationships with some lenders, a good commercial broker may be able to find you a better, cheaper option with better terms, lower rates, longer amortization on your debt, et cetera, et cetera. There's a couple of national firms, Northmark, Berkadia, CBRE. And then in every market, there's typically going to be kind of smaller mom and pop commercial mortgage brokers who may be better fit for you. But again, just some resources. None of this is an endorsement of any of these firms. Do your own due diligence, please. But I just want to lay out some options for you. Okay? Then there's also loan matching sites out there. Janover is one of them. Here, let me show you an example really quick. Again, not an endorsement. I haven't worked with this, but there is more and more of these loan matching sites popping up where if you go to their website, you can input your project details and they're going to match you up with all of the lenders that fit your project detail, your project design, your project specs, in their database. So if you're just starting out, this may be an interesting option for you to look at. And before we keep going, I want to give you a really amazing free resource. I spent a lot of time putting this together. It's a build-to-rent lender vetting guidebook. You can download this free of charge, but it's a super handy PDF document that shows you what to look for in lenders, what questions to ask potential lenders, how to structure your loans, and especially your build-to-rent loans the right way to make sure that, frankly, you don't blow up. It's an invaluable resource. Go to rehabvaluator.com/vet, and I'll put a link below this video, and download this and save it and read it and study it. I think it's really going to help you. Okay? So, ready to keep going? Let's talk about equity. Because in order to secure that bank loan, you're going to need to show the lenders that you have adequate equity lined up. Equity can only come from two sources. It's very simple. You can either earn it or you can raise it. And what you do depends on your abilities and your preferences. If you look at how most of the commercial real estate market operates, it's typically with raised equity. Deal operators, general partners, go out and raise outside equity to complement the debt financing that the deal can support. They typically put very little or any skin in the game, and they're able to do a bunch of deals. There are advantages and disadvantages to this model, so let's talk about those quickly. Raising equity, here are the pros from where I stand. You can get into deals with very little to no cash of your own, right? You simply go out, raise a bunch of limited partner capital, do the deal, boom, then do another deal. You can get into larger projects quickly and scale up. And you can earn some serious money via fees and maybe even get some sweat equity in the deals themselves. The fees can be substantial, especially on larger deals. And you can stack all kinds of fees into these deals. Acquisition fee, financing, developer fee, construction management, asset management, property management, et cetera, et cetera. Again, this is the way that almost all real estate development projects, I would say over $5 million work. But there's some cons to this as well. First of all, you get less ownership. You own usually a small piece of the project, but you're responsible for the entire thing. This is the downside to the syndication model. All of these people online bragging about owning thousands of units, tens of thousands of units, they're syndicators. And while they are responsible for thousands and tens of thousands of units, in almost every scenario, they own a piece, but their limited partners own a chunk and oftentimes the great bulk of the project. In a typical commercial deal structure, especially where you're dealing with institutional or sophisticated sources of equity, you can get very little ownership in the deal. So unless you're putting your own money in the deal, you end up owning very little of it, which means you're responsible for building and managing 200 units, but you own an equivalent of 5 to 10 units. So you get all the responsibilities and headaches, but very little to no ownership. Now, again, there are exceptions, especially if you're working on smaller deals with mom and pop investors where you can negotiate significant sweat equity in exchange for doing the deal. But most of the time, you're going to own a very small percent of the deal. There's also potential misalignment of interests. Your incentives may not be properly aligned with the people whose money you're managing, especially if the bulk of your compensation comes from fees. There are ways to mitigate this. Part of it is by taking some or all of your fees and rolling them as equity into the deal. You also have to answer to a lot of outside parties in your deal. You answer now to a whole bunch of people. And not only does this limit ownership and control to a degree, but it limits your flexibility in what you can and can't do with the project. And then raising capital becomes a full-time job. Raising money and ongoing management of investor relationships, it can become an entire separate full-time gig, building new investor relationships, communicating with investors, managing distributions. It's a lot of work. I think in any healthy development business, you should have an ability to self-generate at least some equity, even if you're going to raise the bulk of that equity from outside parties. There are a few reasons. You're going to need your own cash for at least some of the soft costs, earnest money deposits, due diligence costs, initial engineering and entitlements. Before you can bring a deal to investors, you will likely have costs that you'll incur will have to come out of your own pocket or a partner's pocket. Being able to self-generate equity will allow you to have more skin in the game, even if most of your capital is coming from investors. And having cash and having skin in the game better aligns your interests with your limited partners. And I think that's very important. And then there are going to be situations where you will have urgent needs for cash in your project. You're going to have cost overruns, surprises. And trust me when I say that being able to just stroke a check for some of these unforeseen expenses, instead of going to your investors hand in hat in hand for capital calls every time, is going to be really, really, really helpful. All right? That kind of stuff not only forces uncomfortable conversations with your partners and your investors, but also depletes trust and credibility. So having ability to self-generate some cash on your own, I think, is really, really important. My preference in my development business through my first, let's say 200 some units, has been to self-generate equity and do as many deals as possible that I could own on my own. This allowed me to focus on smaller projects where I learned with my own money, didn't answer to others, didn't risk other people's capital. As I learned, there's nothing worse in my book than learning, when you're starting out, learning using other people's money. I honestly think it's shameful. So if you're starting out, my recommendation is do small deals that you can fund yourself if possible and build your learning curve, and then go out and raise money once you know what the hell you're doing. Ultimately, it's not about how many units you own, but how much equity you have on your balance sheet. It's how much cash are you putting in your pocket every month. In most development businesses, it's a matter of combining active income with passive. Simply put, flipping. So part of your business maybe wholesales houses, or does fix and flips, or builds spec homes for sale. In my case, we build spec homes that then we sell to owner occupants. So I'm able to take the profits from the houses that we sell, use them as equity into my long-term development projects, but then I'm able to take depreciation of my long-term development projects that we put into operation, perform cost segregation studies, take advantage of bonus depreciation whenever possible. And as of recording this right now, it looks like 100% bonus depreciation is coming back. And then I can take that depreciation and wipe out the tax liability on my flips. Then they have more profits left over for my flips to do more development projects. This is not just an equity efficient strategy, it's a tax efficient strategy as well. This is really powerful. If you're watching this, maybe go back and rewatch what I just said. But if you can find a way in your business to either consistently flip houses or wholesale houses, and then use those profits to fund your long-term development projects, you're going to grow wealth really, really quickly. But there's another dimension to this that's even more powerful, and it has to do with discipline. If you can train yourself to channel every penny of the active income, the one-time money that you make, into generating long-term passive assets that work for you month after month after month, you're going to grow your wealth a lot quicker. This is what most people do. And if you watch one of my other videos, you may have seen the slide before, or a variation. They have some sort of a transactional income. Your W-2 job, you're wholesaling houses, maybe you're flipping, but then you're spending that money. Instead of investing that one-time money that you're earning from an operating side of your life, whether it's a job or it's some sort of a transactional real estate business, wholesaling, flipping houses, you spend that money immediately leaves your pocket. It goes to your living expenses, travel, meals, whatever, which means that money immediately goes into other people's pockets, otherwise known as the economy, and really it ends up being in this guy's pocket. I don't know how much you order from Amazon, but I have 3 children, and the amount of Amazon packages arriving at our door is insane. It's obscene. But the point is, this is one cycle of money. You worked hard to earn that money, and it immediately left your pocket. That's known as a rat race. So if you can get to a point where all the transactional income you earn on the operating side of your life, wholesaling, flipping houses, you first wash that money through long-term assets, Now those long-term assets start generating cash flow for you month after month after month. Now spend that money, because that money is going to come back to you month after month after month. There's a very important distinction. And if you can follow this, you're going to be able to build incredible wealth. So how do you earn equity? Well, there's all kinds of ideas. Maybe you have a high-paying W-2 job. There's nothing wrong with that. Consulting, some kind of a service business. Maybe you're an interior designer that gets paid really well. Maybe you've got an HVAC business or a plumbing business or an electrical contracting business. Pharmaceutical consulting, anything that brings in operating income. You work, you get paid. You work, you get paid. Maybe you're a general contractor. You do project management services for other real estate businesses. Maybe you have an online marketing or an online education business, or you do affiliate marketing, or you have some sort of an e-commerce store. That is money that's earned one time. Use that as equity into development projects, even if you're doing single-family homes or duplexes. Now those single-family homes or duplexes are earning you cash flow. Use that cash flow to fund your life, and only grow your living standards based on how much cash flow reliably, recurringly you're earning every single month. It's a very powerful mentality if you understand what I'm saying. Hey, maybe you can do OnlyFans. I'm not judging. They're making a lot of money on OnlyFans. Bottom line is, any operating business that consistently generates one-time profits for you that can be redeployed outside the business is how you can earn equity. All right? And there's an added benefit to this. When you go and you talk to banks and you want financing, banks like to see a lot of income on your tax returns, quite frankly. There's a way to get around that, but it certainly doesn't hurt if you can show a lot of income on your tax returns. And if that income comes from a source that's diversified away from real estate, at least to some degree, it's also viewed as quite favorably. But at the end of the day, your best bet to create significant chunks of income is going to come from doing the same business you're already in, real estate. Build a house, sell a house, build a house, keep a house. Build a duplex, sell a duplex, build a duplex, keep a duplex. Find some land through your deal acquisition pipeline, flip some of it to recoup your money, and then keep the rest, bring it as cash, bring it as equity to a local bank, get the bank to fund all or most of your construction, and then keep those assets. There's synergies there that these synergies matter because your time and resources are not unlimited. All right. So I've got another great video on YouTube that shows you that strategy, how you can, through creative zoning, do deals where you can essentially take some of the land, sell it, and then own the rest of the land for nothing, use that land as equity, and fund your construction and own what you build yourself without equity partners. And again, I'll link to it below this video. Really powerful. Highly suggest you watch this training if you haven't yet. All right. So before I leave you, some action steps. Hopefully this has been helpful. Depending on where you are in your journey, these may or may not be suitable. For debt, go and find 5 local banks in your market. Find out who the loan officer is and invite them out to lunch. Get to know them. Bankers love to get out of the office. They love to make new contacts. Some bankers are incredibly busy and have a full pipeline of deals and already have their fill of relationships. They may decline your request. No problem. Don't give up, right? Ask them questions via email or phone. And that PDF that I gave you that you should download and save, and I'll link to it again, shows you exactly what to say and ask. If you're already rehabbing houses or building anything, by the way, when you meet these bankers, walk them through your projects. Show them the work that you're doing. Walk them through your completed properties. It builds huge credibility for you if they can actually see your work that you're already doing. And for equity, make a list of 5 people in your network that could potentially put up equity as a joint venture partner or a limited partner in your deal. And then pick up the phone and call them. Talk to them. So again, here's the link to the Built to Rent Lender Vetting Guidebook. Go download this, study it, put it to work. All right, so hopefully this has been helpful. If you're not subscribed to our YouTube channel, make sure you hit subscribe. Leave me your comments, questions below. I'm pretty good at answering people in their comments. So if you have questions, let me know. I'll do my best to answer them. And then share this video. And again, we have a huge amount of real estate development education. We're adding more and more here in our YouTube channel. So make sure you subscribe. Make sure you check out the rest of the content we have. All right, that's it. Thank you for watching.